Good morning and welcome to the Providence Quarterly Update for July 2020. I'm Michael Log and I'm here with Grant Patterson, the CIO and founder of Providence. Welcome, Grant.
Thanks, Mike.
Grant, it's been a very interesting couple of months. There's been a huge bounce from the recent lows. Do you want to just touch on that?
Yeah, it's been quite extraordinary. I mean, the speed of the bounce in markets from the lows has been quite incredible. And it's seen, US markets back up to their previous highs and certainly back up to the previous very lofty valuations. So when you stand back and have a look at that and try and understand where that's come from, it's really been a liquidity-driven rally. I mean, in hindsight, the Fed's announcement on the 12th of May of basically they'll buy anything to prop up the markets was a watershed moment in markets, gave investors confidence that the Fed will do whatever it takes to support capital markets. And we saw money flow back into the markets from a liquidity-driven area. Certainly not from our view, from a valuation-driven area. And some of that has been quite extraordinary. The rise of the retail trader in the States is just a new phenomenon that is hard to comprehend. And this is the rise of, Davey the day trader in the US. And if I can, I'll just go through sort of where that's come from.
Sure.
So with the amount of liquidity that's in the system, and this time around, unlike other recessions, there's been no income hit because governments around the world have been, underwriting people's salaries. So there you had a whole group of people stuck at home in isolation, still getting paid, and nothing much to do. So what occurred is that out of the boredom, if you like, they decided to start playing the stock market. They'd seen the market down quite heavily. The view from Davey the day trader is markets always go up. And all of a sudden we got this unprecedented amount of money flowing into the equity markets. Some of the trading accounts were up by over 250% during that period of time. And it was all indiscriminate, buying shares in airliners and cruise liners and that sort of area, which just really pushed the market up. So we saw the likes of Hertz that were actually in Chapter 11 with their bonds trading at 10 cents in the dollar, which would indicate that there's no equity left at all in the company. Yet the share price increased by tenfold because of the rise of the retail investors. So it's been quite an extraordinary rally. As we say, I think it's more a liquidity-driven rally rather than a fundamental-driven rally, but we'll wait and see.
So Grant, given the strong rally and the movement of markets and the day trader, Davey the day trader, where does that leave valuations in your view? Well,
valuations are still very stretched. I mean, it depends on what you think the outlook's going to be over the next couple of years. But, we've seen, the likes of Tesla that has just exploded in valuation. It's now, the market cap of Tesla is more than the combined other, auto manufacturers. In fact, on one day, Tesla's move in the market was more than the total market cap of Ford. I mean, it's just quite extraordinary. So, look, valuations in our view are still very elevated. They've been supported by the huge amount of liquidity, the very, very low interest rates, the very low discount rates. And I guess in a world of, QE infinity, what PE is relative, and it's very hard to know. Our concern is not so much this year and the rebound, hopefully, once the lockdown's out of the way, if that occurs this year. But it's more about the damage next year and the year after and the year after. And we find it very difficult to believe that corporate earnings can get back to where they were pre the pandemic. We don't believe that unemployment rates will be down as low as what they were pre-pandemic. So corporates, we don't believe, will be spending that much. They'll be much more conservative because there's no visibility. That's the whole problem. There's no visibility of what the earnings are going to look like. And as stewards of our clients' capital, we're loath to go and commit money to a market when there's no visibility. So valuations in the main, in our view, very elevated.
And Grant, can we just get a little bit more granular with that and drill down into each asset class and talk about some of the different asset classes that we look at?
Well, we've been talking about the equities, and so PEs are back up to all-time highs, elevated levels. We think in the main it looks expensive. I think the only thing I'd say about the equity market, we've got to be very careful to not just talk about an index level, because there's so much dispersion nowadays between performances of value stocks or growth stocks that by using an index sometimes is misleading. So it's more drilling down to the underlying case for particular stocks, and that's why we have a bias to value managers at this stage, because of the lofty valuations of growth stocks. Within the other asset classes, the A-REITs, they had a very big hit early on, down quite sharply, have recovered somewhat but not back to the previous levels, and we believe a lot of the bad news is built into the prices, particularly in the retail sector. So we think that there's some value now in the A-REITs, in the retail sector in particular. We'd still be very concerned in regards to the outlook for office. Direct property, we're looking at any distressed property that might be out there, and there'll be some opportunities to come up there. In bonds, we have the bonds in the portfolio as a part of our diversification strategy, and that's done pretty well for us over time. Gold, we've had a position in gold now for some time, and that's working well for our clients at the current sort of area, and the alternatives are there to try and sort of reduce the volatility.
Thank you. Can you just touch on currency? That we've been hedged for a long time. We took the hedge off recently. Do you want to just mention that?
Yeah, well, look, we don't trade currency. We tend to, either hedge back into Australian dollars or keep money in offshore currencies as a risk management tool for portfolios. But when we had the correction, and our thesis is normally that if you get a very big correction in markets, then the Aussie dollar normally gets sold off. So our international equities were held in international currencies. When we had the big correction in the market, the Aussie dollar got sold off and got sold off quite aggressively, nearly below 60 cents. We decided that it was time to hedge at least half of our international holdings back into Australian dollars, and fortuitously the Aussie dollar has rebounded somewhat over 70 cents, and that's once again helped that part of the portfolios. So we haven't hedged back 100% of it yet, particularly now that valuations are stretched again. We think we'll wait before hedging the whole lot back.
And Grant, what's the current investment stance?
Well, there's no change really from where we were, last quarter. We're remaining defensive and very diversified. We want to make sure that we maintain the liquidity for some opportunities that might come around. We won't be frightened to reduce our cash weightings once there's some outstanding value. So at the moment we're being very patient. We're collecting income on the way through, albeit at lower levels than what it used to be. And we're participating in the rally in markets, which is momentum driven at the moment, but we do believe it's prudent in order to protect and preserve capital, to retain with a reasonable level of liquidity, and certainly the number one thing is diversification, given the uncertainties that are out there. And
are you seeing many investment opportunities?
There's a little bit coming around. I mean, there's a lot of opportunities. We've been reviewing a hell of a lot of stuff that's been coming around. So where we're attracted to still is first mortgage, fully secured property debt against completed products or product, giving a yield of around about 7 to 9%. We think that's a good area to boost income in. We're having a look at regional motels that are under stress. We think regional Australia will be a beneficiary of the new change of workplace that's around, plus domestic tourism. So we're looking for opportunities in that area. And as I mentioned, in some selected retail REITs, we think there's some value.
And Grant, finally, is there any update from Providence?
Just in regards to workplace, our staff have a choice of whether to come into the office or not. It's their own personal choice, so we don't force anyone to come in if they feel unsafe or don't want to come into the city. We have most of the staff coming in for a few days a week at a minimum. As you know, we're keeping in touch regularly via the Zoom and the conferences and that sort of area. So everyone's safe, remaining safe, and we have that option for our staff. Besides that, there's been quite a bit of movement on the education front. So Harry's completed his FASEA exam, getting a distinction in ethics, which is a great result for him, and he's doing his diploma of financial planning at the moment. Will has completed his Master of Applied Finance and won a scholarship into a course in regards to alternatives. So he's done a great job there. So it's very good to see them continuing as part of our ongoing education of the team. So that's great for our clients. Harry's just purchased a house, so we're very thrilled for him, and I think he's getting the keys next week. So it's been a big year for Harry.
Grant, thanks very much as always. Thank you for joining us as well for this quarterly review. We will be doing more webinars given that we can't get together physically, and we look forward to sharing our views further with you. So until then, thank you very much.